Intro.
Okay, I'm Gary O'Connor. As Kevin said, I run a startup law practice, O'Connor Law Office, and I do a lot of work with early stage companies seeking to raise capital.
I'm Christopher Mirabile. I run Launchpad Venture Group, which is a really big angel network here in town. And I serve at the pleasure of Marie on the TCN Advisory Board, and I'm the chair of the Angel Capital Association. Also just a really active angel myself.
And I'm Ben Littauer. I'm also an active angel here in Boston, a member of a couple of angel groups here, Boston Harbor Angels and Walnut Ventures, love Seed Stage. And so, yeah, that's who I am.
All right, Jerry, why don't you go ahead and kick off with our overview? Everybody kind of level set the table.
Okay, I'm going to take just a few minutes. I'm not going to go through this in exhaustive detail. And at the end of my part of the presentation, you're probably not going to be able to get up, walk out of here, and effect a crowdfunding offering on your own. But I will give an overview of the background and regulatory environment without going into too much painful detail on the rules themselves, except to the extent that I think you might find them interesting or that they're particularly noteworthy. So we'll talk about a little bit about crowdfunding laws. What are they? We'll talk a little bit about the new SEC regulations. We'll talk a little bit about the new Massachusetts rules. And then we'll lead into the rest of the discussion with some notes and thoughts on practical implications about who can use the crowdfunding regulations. So the first thing you have to know is that this all comes from the Securities Act of 1933. And the reason that 1933 is written there in a green circle is that that was a really long time ago. But every time you buy or sell a share of stock or sell a convertible note or try to finance a startup, you're dealing with a law that was passed by the federal government in 1933. And it really hasn't changed a whole heck of a lot since 1933, which is maddening to me, and I don't know if other practitioners in the field feel the same way. But that is what it is, and change since 1930 has been incremental at best. And I think that, to inject a small slice of editorial comment, I think that the way we treat things like crowdfunding and opportunities reflects the glacial pace of change in the regulatory framework within which we operate as angel investors and securities lawyers. So, what does this famous law say? It says every time you sell a security or buy a security, that transaction must be registered with the federal government, or else. Unless you have an exemption. And guess what? Every private placement and every startup company that sells securities has an exemption. The most typical of these exemptions is the so-called private placement exemption. 482 says if you don't do a public offering, you don't have to register your security. For a long time, this meant you had to go out and do a so-called Reg D deal. You only had to go to investors you knew. You could only go to wealthy accredited investors who were sophisticated enough to assess the risks of investing in your company, and you couldn't just sell to regular people who were not so equipped to assess those risks. So there's also state securities laws. That's all I'm going to say about that. So what did the Jobs Act in 2012 do? There were several major reforms within this piece of federal legislation. Number one, they instituted what I'm going to refer to as Title II crowdfunding, because it comes from Title II of the law. That says you can advertise your offering wherever you want. You're not limited to people you already know, or people that your banker already knows, people that your lawyer already knows. You can put your offering on the internet. You can put your offering on a TV commercial. You can stand on the corner, proclaim that you're doing a securities offering. Advertise it however you want, but you can only sell to those aforementioned accredited investors. That's Title II crowdfunding. It also instituted what's called Title III crowdfunding. Now we're getting closer to what we think of when we think of crowdfunding. I'm going to pause for a second. Who has participated in an IndieGoGo or Kickstarter or GoFundMe crowdfunder, either as a proponent or a donator? Okay. Who has done anything like an equity crowdfunding deal? Okay. So we're a lot more familiar with Kickstarter, with IndieGoGo, with things like that, which are not securities crowdfunding. Title III crowdfunding from the Jobs Act brings that type of transaction into the world of securities by saying, yes, you can now advertise your securities. Yes, you can sell to regular people that are not accredited investors. Yes, you can have all these investors be holders of your stock without having to register your securities under the 34 Act. But there's all kinds of limitations. We'll talk about a few of the more significant limitations. Finally, just as a side note, the Jobs Act also instituted the so-called Title IV crowdfunding also known as Regulation A+, the mini public offerings. That's pretty far beyond the scope of this discussion. So for this discussion, we'll primarily be talking about Title III crowdfunding and the state equivalents. We're not going to talk too much about Title II crowdfunding, except I will note that, in my opinion, Title II crowdfunding was put into action pretty soon after the Jobs Act of 2012. The SEC didn't drag their feet that much, and I think it's taken off like a rocket ship. There's all kinds of Title II crowdfunding deals out there, and all kinds of deals are getting closed. In contrast, the SEC had, I think it was 90 days or 180 days, to implement regulations under Title III crowdfunding. They just came into effect this year, 4 years almost after the 2012 passage of the Jobs Act, which indicates to me that the SEC is not too crazy about this and doesn't really care if we ever get crowdfunding off the ground or not. So, enough editorializing. Not going to talk too much about Reg A+. Talked about that. So, basically, you can raise up to $1 million a year in a Title III federal crowdfunding deal. You can only do it if you use a broker-dealer or if you use something called a crowdfunding portal. And there are limitations on the number of shares people can invest, and that's kind of fine print. Basically, if you're not a rich person, you can invest about $2,000 a year. If you're an accredited investor, you can invest up to about $100,000 a year. Very broadly speaking, there's a lot of fine print in there. Now let's talk a little about the crowdfunding portals. Again, under the securities law, you need to be a broker-dealer in order to effect transactions in securities. However, under the crowdfunding rules, there's a new thing called a crowdfunding portal. That if you file a form, crowdfunding portal, Form CF, register with the FINRA, formerly known as the NASD, which is the regulatory authority that regulates brokers and dealers. You have to register with them, but you don't have to be a broker. And you have to file it with the SEC, and they approve your application. Congratulations, you can be a crowdfunding portal, and you can list these crowdfunding offerings. So what is a crowdfunding portal? There are some things that a crowdfunding portal has to do, there's some things that a crowdfunding portal can do, and there's some things that a crowdfunding portal can't do, not allowed to do. Like we said, you have to register, you have to get a membership in FINRA, even though you're not necessarily a licensed securities professional. You have to have background checks and regulatory checks, and there may be other requirements coming down the road. Well, what can't you do? You're not supposed to offer investment advice or solicit offers to buy or sell the stocks that are listed on your portal. You can, and this was a little bit of wrangling between the initial regulations and final regulations, you can select or curate or categorize the companies that are listed on your portal, but you can't offer investment advice. You can say, hey, I'm going to list only real estate offerings, because that's what I like. I'm going to list only medical device companies that are doing something that I think are good, that are doing things that I think are good. But you can't say, and by the way, Company A I think is a lot better than Companies B and C. Really, you should buy Company A. You can't do that as a crowdfunding portal. You're supposed to be more like a one-stop shopping, and investors can make their own minds up. And there's a bunch of stuff about whether you can get deal-based compensation as the portal, and whether you can pay deal-based compensation to your associated persons. I think that's a little bit boring for this crowd, and I don't want to take up a lot of time on that because I want to get to more comments from the panelists. So that's crowdfunding in a nutshell. What are the pitfalls of federal crowdfunding? Hopefully we'll get some firsthand pitfalls of federal crowdfunding. But basically, the SEC has kind of made it a little bit hard to use. Among the more notorious of the problems with Title III crowdfunding is that if you're going to raise more than $500,000, you have to have audited financial statements. Who has ever heard of a startup raising their first $1 million that has audited financial statements? Just as another indication of how dumb I think these rules are, I think the rule is if it's your first time doing crowdfunding, then you can raise up to $1 million with only a review of your financial statements instead of an audit. Which, if you remember what the SEC is there for, that doesn't make a whole lot of sense to me, because is this something that requires SEC action for investor protection or not? Do you need an audit to protect your investors if you're raising $1 million in crowdfunding, or don't you? what is this if it's your first time stuff? I mean, why is the SEC saying, okay, you can do it this time, but that's it? No more. The investors must be protected next time. Don't really get it. So I think that's about all I'm going to say for introductory remarks about Title III crowdfunding. It's there, it's up and running. I think Wefunder has a pretty good site that you can go to, and they've really made it user-friendly. They've done as much as I think one can under the restrictions. I like what I see there. And I'll just spend a couple minutes talking about the state rules and then see what we can get into here. So interstate crowdfunding came about during the time between the passage of the Jobs Act of 2012 and this year when the federal Title III regs went into effect. And they came about partially because there was pent-up demand. People wanted to do these deals. People are eager to invest in opportunities. People want to use crowdfunding to raise money for their ventures. And meanwhile, while we were not passing rules, in places like the UK and other jurisdictions, crowdfunding has really taken hold as an element in the overall capital raising picture to an extent which has eluded us thus far. So state legislators and administrative agencies began to take action. I'm not going to bore you with the rules, but I will tell you that in Massachusetts, we do have an intrastate crowdfunding rules. And what do you have to do to take care of yourself and qualify for that? You have to be a Massachusetts entity. You have to form your company in Massachusetts. No Delaware corporations, please. You have to be a Massachusetts corporation or Massachusetts LLC. Number two, you can only offer and sell to investors in Massachusetts, period. No New Hampshire investors need apply. Number three, over 80% of the proceeds that you're offering has to be used in Massachusetts. So what does that mean? Who can use intrastate crowdfunding? Think of things that stay in Massachusetts. Think of a renewable energy project. That's not going anywhere. That's a good candidate for intrastate crowdfunding. Think of a restaurant. Think of a real estate development, a community-based real estate development perhaps. Pretty good candidate for intrastate crowdfunding. And by the way, the intrastate crowdfunding rules do not require you to have audited financial statements to raise up to that $1 million. So there's different restrictions for intrastate than there are in Title III, and one's not necessarily inherently better than the other. But I believe that if you're in Massachusetts, depending on the type of project or startup you're trying to get off the ground, you should take a look at the intrastate rules if you want to do crowdfunding. Question?
Does the intrastate allow general solicitation?
Yes. With a caveat.
Not outside the state.
That's the caveat. Now, if you talk to the Secretary of State's office, which I have on a number of occasions regarding this, the real question is, can you put the offering on the web and offer it? Right. I think you can. The Secretary of State's office thinks, oh, gee, that would be nice, but we're not sure if you can or not.
So only do it a little.
Yeah, only do it. Maybe only do it one time, right? Yeah.
Real fine print.
But here's to get into the nitty-gritty, the SEC has released a telephone interpretation, which they do. It's sort of the lowest level of pronouncement. And that telephone interpretation says, well, remember 1933, we said you couldn't generally advertise your offerings. We still kind of mean that. I know there wasn't any internet in 1933, and we don't really know how to grapple with the fact that there is one now. You could limit your sales to Massachusetts residents, but still, geez, are you offering to a New Hampshire person if you put it on the internet? Hey, we know, if you have some technology that will limit access to that offering to people that are coming from a Massachusetts URL, yeah, that might work. So that's where it stands. If I was asked to write an opinion, or if I was asked to do battle with the SEC on that, I would have no qualms whatsoever about trying to get definitive no action letters or something like that. But there is some deliberate, persistent doubt that has been sown as to whether you can put your intrastate offering on the internet. I believe that will be clarified as soon as somebody actually uses the intrastate rules, which hasn't happened yet.
Some guinea pigs.
Right, guinea pigs welcome. Right, so both the federal and state crowdfunding programs are out there. I believe that they're both important tools for startups. I think in the right circumstances, startups and projects, remember real estate projects, renewable energy projects, can use them to raise critical early funds. But there's lots and lots of pitfalls, lots of implications, lots of complications, and that's where we are. But Yeah, question.
Just to clarify, so you don't need to use a portal for interstate crowdfunding?
You do not need to use a portal for interstate crowdfunding. That is correct. Question.
Yes. Are there restrictions on the type of entity that can be formed?
There are, well, for now, what are we talking about? For Title III or for intrastate or?
Both.
Okay, for Title III, no. It's got to be some securities issuing.
It's got to be able to issue securities.
Yeah,
Right,
got to
like
be an
LLC.
securities issuing entity, and I believe it has to be formed in the U.S.
Okay. But for
Yeah.
example, an LLC.
Oh yeah, an LLC can issue debt or equity securities, no problem. And an LLC, for example, if you were doing a solar project in your community, you wanted to raise $1 million from the members of your community, you could write up an intrastate offering, find somebody to sell it for you, or sell it yourself. Sell membership interest or debt interest in the LLC. Yep, that's a valid.
But you're going to be,
valid choice.
you're going to be doing annual tax filings, and you're going to be selling membership units, not.
What about something like a condominium? Which is a different kind of structure.
We should introduce our fourth panelist,
Yeah.
and I have a couple questions for the audience just to gauge.
Yeah, exactly. So why don't you introduce yourself first? Go ahead.
Sure. Hi, folks. This is Ed Damiano. I'm a professor of biomedical engineering at Boston University and president and CEO of a new company called BetaBionics, a Massachusetts public family corporation.
All right, so Chris, why don't you kick off with your thoughts on this regulation?
I was just, before I do that, before I put my foot in my mouth, I just want to quickly gauge the room. Raise your hand if you're super excited about crowdfunding and think it's going to change the world. Keep it up if you're planning to use it yourself. Keep it up if your company is a super high potential growth company that is going to go on and take other kinds of investors and really make a dent in the universe. Okay, I think I have some bad news for you. So that was a great introduction. Thank you very much. So let me make a couple of quick comments. Just I had the pleasure of sharing a stage with the guy who wrote these rules, and you're absolutely correct that the SEC isn't too keen on having to put them out. And it's not because they're bad people, it's really because the SEC has two jobs. One is to promote the formation of capital and make us a competitive nation here on planet Earth. And the other is to make sure there's order in the markets and minimize fraud. And unfortunately, the political reality that the SEC faces is that people complain about the first job, but they go ballistic about the second one. And in fact, there's a bit of a fortress mentality at the SEC, just because, for example, every Thursday over lunch, the commissioners get together and talk about the fraud cases of the week. So there's a lot of bad people out there, and it turns out that protecting investors and maintaining order in the market and preventing fraud is not an easy thing to do. And so that's why these rules are pretty stiff. They're pretty tight in terms of the amount of money and the amount of disclosure and investor protections that are sort of built into this process. And that's why the rules for these new funding portals are pretty tight. If you're trying to find the throat to choke in this scenario, it's these portals. They are under a lot of significant responsibilities, and they are going to be the focus of regulation. But I'll introduce a concept and hand it over. But I think what all of this really boils down to is that because of the reality of these rules in the context of the SEC having to maintain order, it's pretty troublesome money. It's pretty expensive money, and depending on what you're trying to do, it might not be your best option for raising money. And I'm happy to expand on that after we've heard some other voices.
So I'm going to jump in for a minute. I'm actually a very small investor in one of the portals here that was mentioned before, Wefunder. Now, this Title III stuff went live on May 16th. We've got a month under our belt, okay? So the data is a little scant, but I did a little bit of research on this. 5 portals went live on May 16th with a total of about 33 deals, okay? Not a lot of deals. Wefunder had 20 of them, and the rest were split among 4 other, ranging from, I guess, half a dozen on one down to 1 on the smallest of these portal sites. So there weren't a lot of deals out there. But what happened is, so on Wefunder, for example, the deal structures were all over the map. The deal types, ranging from a biomedical B corporation, which Ed will tell you about what that really means, to do-good urban renewal in Chicago, I think, to a custom jewelry shop, to all sorts of things, high growth to no growth to we don't know growth, all over the map. And the structures range from, you can get common stock, you can have debt, you can have a revenue share, you can have a safe. Now, how many people in this room know what a safe is? We've got half a dozen in this room, and this is an educated crowd. We're in Boston here. We've all been to TCN events before. We all understand that this thing called convertible debt. Well, these are safes. These are even worse than convertible debt from an investor point of view, but there they are. And you expect Joe the plumber to go up onto a portal site, look at a safe and say, what the hell is that? So these deal types are all over the place. The structures are all over the place. So in the end of the day, by the way, these portals are typically structured, I don't know if that's by law or not, that you have to reach a minimum, just like an old Kickstarter campaign, before you get the money. And the minima can range from 20,000 to 500,000. Interestingly enough, one of the deals that did trigger changed their minimum after the original structure. I don't know if that's allowed, but apparently it was done. I didn't, being done and being allowed are 2 different things. But I went through and looked at all the deals out there. And this is all public information, so I'm not sharing. It's public offerings. All public information, which is just amazing to me, because if someone asked me about one of my deals, how much money went in, I'm saying, I can't tell you that. But these, they can tell you. They, in fact, have to tell you. So, 33 deals, or something like that. How much money? Okay, is it $10 million or more? Raise your hand. More than 10 million, who thinks? Well, dollars.
So far.
So far.
For all the
So far
years.
invested.
In total.
In total. It's actually under $2 million, and more than 10% is sitting on this panel, okay?
It's nice to be 10%.
That's how much has been committed. Not all of it has reached the trigger, okay? So well under $2 million. This pent-up demand that Jerry was talking about, we haven't seen it yet, okay? There isn't a groundswell of billions of dollars. Now, angel investors, Christopher can answer this question like that. How much angel investment in 2014?
Angel's about 25 to 27 billion a year
Okay,
in the US.
10,000
across
times that.
70,000 deals.
10,000 times the 2 million. Okay, we're only talking about a month, but it was an interesting month because it was the first month, okay? There's no interest here yet. What I think is that the companies that are crowdfunding and the portals that are bringing in the traffic for crowdfunding have yet to find the product market fit. The product is the companies, and the market is this group of unwashed masses, not the accredited investors, who want to invest in them. And we haven't found that product market fit. I think it will happen. I think there are portals out there that are very interested in finding out, no, we're not going to offer deals all over the place. We're going to take a particular vertical, a particular type of deal, a particular structure of deal. But it hasn't happened yet. We haven't found it yet. It's too early. You have a question?
Yeah, so I'm gonna kind of unique position. I've done crowdfunding, traditional crowdfunding, and Kickstarter just recently, and I run a early stage startup. So we have people contacting us regularly, asking to buy our shares. Now, these are not sophisticated people. These are potential customers. They might have already bought something from me, but they also want to buy stock in the company. Now, I can't sell it to them because that's not the position I'm in, but they want to buy it. Now, I like the idea of equity crowdfunding because it's very democratizing, right? Regular Joe Schmo can invest in something that they like, right? Just like regular Joe Schmo can go and buy a share of Apple if they can afford it, right? They're not educated, they have a little money, they want to buy some Apple they think is going to go somewhere. Now, I think Apple as an entity is much more sophisticated in being able to fool regular Joe Schmo than I am, because they're Apple. So, it's like buying a car from a used car lot.
But you might be better at fooling yourself than Apple is.
Oh, yeah, absolutely.
That's
Absolutely.
meaning well, right? There are
Apple's
a lot
got
of-
200 billion, Apple has $200 billion in the bank, right? So.
Right, so no, I mean, it's much higher risk, right? So I've also come from a background in investment banking, very traditional, I traded credit default swaps when the economy grew. So I understand the value of standardizing terms of things, because that's one of the reasons that our economy went belly up, right? So when you're trading securities, right, you have very standard terms, right? So all these things, all this Wild West stuff that you're talking about, that will go away.
I agree.
Yeah, it will have standard term sheets, standard agreements, maybe accredited, maybe a rating agency, maybe insurers. All that stuff will come in the secondary market. I'm sure of it. But right now, I am excited. The reason I'm here, I'm excited that a regular person can go in and they can buy a share of a company they like. Now, the company might lie to them, and they're lying to themselves, like you said. We're constantly lying to ourselves about our growth potential because we just don't know any better. Right? We don't have that track record. So that's the reason, that's the thing I find exciting. And regarding the product market fit, I think it's an education problem. I think people want to buy shares of not public companies, of liquid assets, but they just don't know how.
This is mom and apple pie. This is good stuff, right? The concepts you're talking about are great. The facts of the rules don't comport with that vision. The rules are pretty, I mean, if you take that one shareholder and you do one of these offerings, the transaction costs are non-trivial. I mean, really, and including disclosures before the deal, and then ongoing disclosures afterwards, and you're kind of stuck with that shareholder and that regime forever until you redeem the shareholder or get acquired.
It's in a liquid market.
Just on product market fit, and let me just say one thing about that. I think that's a good way to articulate the problem, and I think it's, 1 month into Title III and 0 deals under the state interstate regulations, it's way too early to tell. I believe that, and I also think it's correct that you're not exactly laying the right foundation for a robust capital raising activity in the future. It's not exactly the greatest cap table in the world to approach an angel group or a venture capital investor with. However, product market fit. If you're trying to buy a vacant building to put a community-based restaurant in your community, if you're doing a real estate development project, if you're doing a renewable energy project, the key thing being, is this a project that needs to raise capital once? Are we going to develop our capital budget, raise the capital, build the project, and get the money?
All right, so why don't we have Ed speak to this
I
topic?
think this is actually, you've got product market fit right here.
Right.
Yeah.
Let's talk about your experience.
Yeah, of course,
Through
of
it.
course. So why did we do this? So we have a medical technology company. It's a Massachusetts Public Benefit Corporation. We built this device. We call it the iLet. It's a bionic pancreas, and it controls blood sugar levels, externally ward device. Controls blood sugar levels in people with type 1 diabetes automatically. So it really is a big paradigm shift for those of you who know what it's like to live with type 1 diabetes. And we've been in this business for, we're a startup, technically speaking, but we've been doing this for about a decade. We've been in clinical trials for 8 years, over a decade's worth of preclinical and clinical trial work into this, so we're well into this. And our goal is to be into our final pivotal trial next year and get approval for this device in the middle of 2018 to get it out to people. But we started this company as a public benefit corporation, which itself is a very new concept for those of you that don't know. The company is following these rules, these state laws have been around since 2010. There are only 30 states in the US now that actually have public benefit corporation laws. And what it allows us to do, in fact, obliges us to articulate a public benefit mission for the company. And we have like a 4-pronged approach, but the umbrella goal of our company is to make sure that we make decisions that act in the best interest of the type 1 diabetes community. This benefit mission allows us, this is articulated in our articles of incorporation, in our corporate bylaws, it allows us to make decisions on behalf of our benefit mission that can supersede returning equity usual pitch on Wefunder. We want we have no desire to flip this company. So how many entrepreneurs say that? We have no interest in flipping this company. We tell our potential investors, and it's very plainly stated on Wefunder, there's no exit plan, there's no exit desire. And if we can do this thing all the way to the finish line without an IPO, we're going to do it. In other words, you don't get your money back. That's not why you're investing. You're investing likely because you have literally skin in the game, as we call it. A kid with type 1 or you have type 1, and we could use the resources. But the $1 million is not why we're doing this. It's expensive money, as you've heard. We have a couple of parents who are lawyers on our management team, and they put together the Form C, which is not trivial themselves. They did this for us. It was a Herculean effort. I'm telling you, it was not a simple piece of work. It's going to continue to be a huge amount of work. There's a lot of maintenance to this. I'm answering questions as they come up with all these other things I'm trying to do. And just loading up the Wefunder site was a ton of work. But the SEC, I think, suggests that you budget $75,000 just in legal fees to put this thing up there, okay, to put the Form C together and so forth. So it's not for the faint of heart. And we're very particular about our investors. You can actually profile them. If we have 500 investors is all we can take. They recommended we limit it to 480 because of divorce. The divorce rates in this country, so they look at that. They look at the likelihood of divorce, and so we're budgeting 480 investors, and we're at 330. We've raised about $250,000 so far. So again, people are very slow to get in. What I wanted was $10,100 investors, but there's this, and that minimizes the risk for them, right? It's a huge pain in the butt for us, right? But it minimizes risk for them. So we can profile if we exceed the 500. And pick people who we really see are in this for the reasons that we think are the right reasons, and have no desire to make money on this. Our first investor was Eli Lilly, and they put $5 million into this company. They took a 5% equity stake when they did it, and they said when we approached them, we're very special in their mind. They don't want to take us over, and we're not for sale. They know that we're small and agile, and we can do things that a big pharma can't. But we make their drug better. It works way better on our platform than any other platform, so they want us to succeed. We approached them with the regulation crowdfunding idea, which is really about bringing the T1D community into our privately held company. Since we have no plans to do an IPO, how do we get the T1D community to literally own a piece of this company? We saw the way to do it. Lilly said there's no other company we would invest in where we would have let this happen. But you guys, okay, because this is an untested waters. It seems like a nightmare, and their outside counsel advised against it. We said, we understand, we get it. We are an experiment in the making. And our Benefit Corporation, we're the only medical technology company that's ever incorporated as a Benefit Corporation, as far as I know. And it's not something extremely conservative medtech companies would do, let alone a crowdsourced funding initiative. What we're trying to do is very different from what I think most entrepreneurs are doing. So I say this with significant warning. It's a ton of work. It's going to be hugely burdensome after you take on these investors. And you just got to decide, is this really what you want to do? If our goals align well with this, I think we do have a good product fit potentially, but it's not without a ton of effort. It's going to be a lot of work.
Okay, let's then get back into the questions. Al, you have a question, right?
So part of the thing is, I was involved in all this when the JOB Act got passed, right? And everybody was very excited at the time, and then nothing happened, like you said, for 4 years, right?
There's actually a lot of blogging about it.
A lot of blogging. But here's the thing, and it's something in reference to what you said earlier, right? I think the way that we're approaching this is kind of a little off, right? This is not for the companies on the Techstars track. This is not for companies necessarily, that can't, because what got put out in the early days was all the VC guys said, oh, well, we don't know if we would invest in a company that did equity crowdfunding, and that put a hush on everything, right? Because as you know, VCs and angels want to be the first ones in, right? And they don't want to be behind non-professional investors. I'm just talking in
You lost me at that.
I'm talking in general.
I think they did put a hush on it, but it wasn't necessarily because they were mad that they weren't going to be first.
No, not mad, but they didn't want to be in the same pool necessarily.
Now you're losing me again.
But I don't want to debate that thing. I'm just telling you what I saw as somebody who was particularly interested in this, right? In a way, the whole idea, because you started, your premise was, I got some bad news for some of you who think you want to, start off this way and maybe try to get other kinds of funding, right? So that is what you said, right?
Yeah.
And I understand the reason for that.
Yeah.
But in a way, the people who need this the most, right, are not you guys, and not the.
No, I'm
right?
with you on that. I think this is an interesting type of financing. I think ultimately it's a story about stakeholders, not stockholders.
Right, that's why I really enjoy this story. So I guess the thing I want to say is in terms of, I grew up in Boston, I grew up in Dorchester, I'm working with Kevin on some stuff at the Roxbury Innovation Center, right? And I've been part of different cohorts of different startup companies. There are companies that are never going to get funding any other way, okay? If we had a level playing field about who gets funded and why, this would not be as necessary as
What's a level playing field?
Well, when you have less than 1% of all companies being funded by people of color and women, right? That's not a living playing field, right? So that's what I'm talking about, right? There are people who are in companies. I was in a coffin boot camp at Dash Challenge, right? Most of those companies are never going to get money from VCs and angels, right? But this equity crowdfunding for states and even the federal stuff, right, would be a godsend to many of these companies who are not going to be able to get regular quote-unquote funding, right, from VCs and angel groups, right? And I've talked to many of them, right? So what I'm saying is, like, in a way, it's a matter of perspective, right?
So you familiar with the concept of a food desert, right?
Absolutely. I grew up in one. I know very well.
So this is a funding desert. Why should those companies that need help the most be stuck with crazy high, stupid transaction costs? That's totally unfair.
Because the other the other avenue is closed to them. Is what Alice said.
Yeah, I know, but I'm just
agree
pointing
with
out that it's.
Yes,
this is better than nothing, but it's still
let me
too
say,
expensive.
But the whole country works that way, right?
But it's better
you
than
you
crap.
pay. Hold on, you pay more for everything in the inner city than you pay anywhere
But
else,
my
right?
point
So
exactly.
there's nothing new about this, right?
I agree with everything you said, but I don't think it's limited to those companies
I agree.
that are disadvantaged
I agree, yeah.
by the society.
Yeah.
There are so many companies that angels and VCs pass over.
Right.
And you can bet there's an Uber and a Facebook in that crowd.
Right.
And they're also going to get funding through this. And then what I think will happen is that the VCs will hold their nose
Yeah.
and go spearfishing in the pool of crowd-funded
I agree with
companies
you.
and pull the Ubers out.
I agree with you.
And I hope some of them will
But it's
be
going to take
head by people.
that to happen.
Yes.
All right, so Chad, you had your hand up earlier.
Yeah, well, you kind of took my point where I said that this isn't for the next Ubers, but it's for the mom and pop bookstore that has to go against borders.
Right.
So it'll, raise $1 million, you'll be able to fund it and have a nice community thing, or a community center or something along those lines.
Large animal hospital that a community needs.
Another question kind of on top of that is with the legalization of marijuana and medical marijuana coming through the states, do you think that this is a path to, say, a dispensary or a delivery center, something along those lines down the line?
Yeah, it could be. Actually, I think there's an angel group out, is it in the Rockies? Somewhere out there that
You'd think it
actually
might be in the Rockies.
specializes in angels. So it specializes in marijuana industry and related stuff. But so there may be conventional money available to those companies, but to the extent there isn't, this might be a good path.
In Boston, I don't know of many angels who will actually touch those kids.
Also, in the Massachusetts, the regulations around ownership of those marijuana facilities is so tight that I'm not sure that they're suitable candidates for crowdfunding.
No, there are many adjunct products.
Right.
Oh, sure. Like there's a guy that makes a phone case that you can use to roll up.
Convenient.
Yeah. So, but to the point about who this is good for and whether it costs money and whether it's good for community, because I firmly believe, having done a decent amount of research and market-based research into this, that the opportunity for impact crowdfunding at the state and local level is real, and I don't necessarily think it has to be at the cost of $75,000 per million.
Right.
Or more. I think that there are economies of scale. I think that there are automation tools, and I think that the people who are going to win this and win, meaning not make $1 zillion, but bring capital raising into the community, and I think it will happen, I firmly believe it will happen, are the ones who are going to be able to capture the ability and to deploy the ability to manage the crowdfunding stockholder base that you're going to get, do it at a scale duplicable, in a duplicable manner, and be able to go out to these people who want to raise money once for the food truck, once for the
Here's a great analogy. lots of people have given mortgages within their families, right? And when you do that, it's kind of a pain in the neck to create the paperwork. And so there are companies that have gone into the market and said, hey, I'll give you a turnkey platform that's got all the paperwork and it's got the reminders and the payment schedule. It'll figure out the amortization. I think this is similar to that as well. When you have a situation where a lot of stakeholders are coming together about something they're very passionate about, a business that deserves to exist, or saving a community like a campground from development, or saving a beloved product, from being lost, those kinds of things. They're going to do it anyway. The fact that there's a turnkey method for doing it is fantastic. I think that's a great thing. It is a little high, but in those contexts, the transaction costs are not that important. And the fact that it may complicate the company's life down the road, or it may complicate future fundraisings, isn't going to matter as much.
Ben, you hand up.
Well, I think there's a conception that if you're going to raise $1 million through Title III crowdfunding, that you're going to end up with $1,000, $1,000 investment, and it's going to complicate as you move forward. You want to raise add-on rounds later on, that you have 1,000 shareholders that the investors further down the line are going to have to deal with. And I don't think that Title III is always going to be like that. It's going to be, it just adds efficiency to raising capital, where you don't have to take, like typical crowdfunding or rewards-based crowdfunding, you're going to take every dollar you can get. With this, you don't have to take. If somebody wants to give you $1,000, and you think, well, this could be a problem investor. As you're vetting your investors, you don't have to take $1,000 from someone who's going to be a problem down the road.
No, definitely not. But the math is against you. The arithmetic really doesn't work in your favor, because the limits the income limits are such that, as the money piles up, the number of investors piles up in a pretty linear way. That's the challenge. You don't have to take them all, but it would be hard to raise $1 million through this without accumulating a pretty significant number of investors, just because at least at the way the market stands right now, if you were going to go try and find 10, $100,000 investors, by definition, those are going to be people with some disposable income, some sophistication, and some options in terms of different places they could put their money to work. And unless they're really aligned with the cause, and it's a very non-financial kind of alignment, they may find other opportunities more attractive than yours, just given the transaction costs and the implications.
But that's assuming that all that sophisticated money is only interested in accumulating more money.
Right. No, I said aligned. They either have to be aligned with the cause, or it's lots of smaller investors.
I'm going to disagree with that, in that I think that over time we will see a lot of classic angel and venture deals coming through the crowdfunding site, and again being identified later. Maybe the VCs will take out the original commons for that specific reason, that they just don't want all this crap hanging around. I think that's going to happen. I think this is going to be as disruptive as Uber to taxis, but it's going to take 5-10 years.
I agree.
Yeah,
James? We have James. Okay, good.
I just had a question that actually kind of ties into what you were saying a second ago, Ben. Once that hurdle is achieved, and let's say that the huge unicorn comes through this crowdfunding, and then all of a sudden, the angels and the VCs say, hold on, what's going on here? The information, maybe this isn't what people think of from my perspective, the information that's disclosed and provided through the portals and through the sites, is that the type of information that an angel or a VC would be looking for in terms of making decisions about what deals they will make, as compared to if they were just walking up to a company that they were referred to and doing their more traditional deal? Are you getting the type of information from the portals that you would need to make those decisions?
Today, no.
It's probably it's a subset. It's business information. It's relevant information, but it wouldn't be enough.
The required information is often more information than we get from our companies, but it's not necessarily the right information.
Right, it's not required, but that doesn't mean that you can't post that information.
Exactly.
So a more sophisticated raise is going to offer that, the terms that, that angels and VCs are accustomed to seeing. But to his point, women and people of color create businesses and business plans with appropriate terms, but they can't get in front, they can't get their, what I call their Shark Tank moment, that's open to the public. So there's gonna be deals like that available to the communities that wanna support someone in their community.
I saw a limit of $2,000 per investor. Is there a limit to the number of investors?
500.
500.
So there's some
And
to-
this is its biggest complaint, right?
Yeah, this is something I mean, if it, when you're talking about crowdfunding, if you're really talking about it in the pure sense, right, then you want to have as many investors, you want to offer the opportunity of as many investors taking as small of a risk as possible.
Yeah, I was thinking of that the other side of it, if you can get huge numbers of investors, this becomes like going to the track.
Right. Exactly. So of course you have the headache of dealing with 10,000 versus 500 people potentially if your minimum investment is say $100. But if that's exactly what I'm looking for, because I want to get the community to own as much of this as possible, or as much of the community to take a stake in it. I think it's the perfect way to articulate it. I'm looking for stakeholders, not shareholders. And as long as they understand that, and we're very plain in our language about that, I want that number to be as high as possible with people taking as little risk as possible. The analogy to what we're doing is the Green Bay Packers. One of our board of directors members said this, right? There's only one reason to live in Green Bay, right? And so everybody wants a little piece of it, and they don't care. They paid $100 for it, $10 for it. What they want is a stock certificate framed on their wall. And that's kind of what we're looking for, that kind of passion for what we're doing. And $100 doesn't matter. So we're willing to take on the challenges of 10,000 people, but I'd much prefer that to 500 people and falling short of the goal. I'd like to at least get the million.
Mike, and then over to Marie. Mike?
So, just a very quick question. Why didn't you do like an IndieGoGo?
That was my question.
On IndieGoGo. So a lot of the stuff that we're talking about, there are traditional crowdfunding platforms that don't offer products in exchange.
Right.
They offer a heartfelt thank you or something else. It's just that you own the company, you support the company. This is not a new concept. So my question is, why didn't you do that?
We certainly could. There was the crowdfunding approach. We had the resources in house to do the heavy lifting. So that some of that $75,000 that's just gone. They just did that for us. So we have a leg up there in that respect. And we also were hoping to leverage the visibility of May 16th, right? And so too is Wefunder. So when we first met Wefunder, it was just a few months before they went live with their portal. As soon as they met, Ed and Serafino, our general counsel and benefit officer, they said, "You're our poster child." As soon as we met, they said, "This is the one we want to put up there." And we then worked together with them to run some publicity on this and put together some videos. And so we thought we'd take an opportunity to get some visibility on this, and we weren't sure just how big of a splash it would be. So to some extent,
from your perspective, being one of the pioneers in this type of crowdfunding from a startup's perspective, so let's say that to run a successful Kickstarter, it's probably for the typical Kickstarter about 50 grand, right? Because you have to drive all the people to the platform like you do too. Right? So this is just a platform where it allows you to sell people, but you got to drive all the shareholders, stakeholders to it. In your case, a traditional startup, we're looking at 150K, right? I'm guessing. I don't know, like if you actually had to pay your bills, what would they be? I'm guessing they're crazy expensive, right? See, if you actually had to pay everything on
expenses
marketing
as well. You have to, once you fulfill your Kickstarter, you mail the product, you're done.
Yeah.
This is
There's
a
ongoing
lifetime
stuff.
commitment.
right?
Yeah,
Because you
exactly.
own those
So the
shareholders.
onboard, but startups don't think like that, right? Startups want money now, and then they'll deal with all the consequences later, right? So I get that. I'm a startup, right? So, but let's say the upfront cost, right? So what would drive somebody? I'm trying to understand from a consumer perspective, right?
Right.
What would drive you as a startup to invest 3 times more resources into running an equity crowdfunding campaign, which has that, that leg of support that you have to provide forever for the history of for the duration of your company, plus that extremely high upfront investment over an IndieGoGo, which is pretty formulaic. There's plenty of people to support you. There's a very clear path to it, and there's much less regulation to deal with. So,
Yeah.
from not necessarily from your perspective, because you have that inside track, but from somebody who did it, what do you think would drive you to do that over a traditional crowdfunding campaign?
You want to take that?
Well, I mean, I think I've had a company try that, and the answer is largely May 16th. The hope was that there was this dam built up, and behind it was this reservoir of hungry investors, and taking advantage of the first launch of equity crowdfunding would have a big flush of investors or participants, stakeholders into these companies. It turned out not to be particularly true, but that was the hope, and that's really what people were banking on. Ongoing, I don't think that's going to be the case. You're still a bigger fish in a smaller pond than compared to Kickstarter or IndieGoGo. I mean, there's still only 30 companies out there.
The funding you're talking about is at the product level, not at the entity level, so
Yeah.
it's transactional. You get it done. I mean, the notion is there are people who want to have a stake in what he's doing, and they
Right.
want to support it. And in some companies, it might be an expectation of a share of future profits. In his case, maybe not, but they want a different relationship with the company. They're a stakeholder, not a stockholder.
Right. I should also mention, we had something else. Besides having the resources that could do this without upfront cost to us, we had something else. Because of the long history we had in clinical trials, we had a database of 2,000 people who are self-selected group who have reached out to us over the course of the past 3 years, wanting to either be in our clinical trials or who had donated $2.5 million over 24 months to Boston University, to my lab, to keep this technology going. And I'll just tell you, that was a tremendous amount of work to raise that money. I was going to living rooms, knocking on doors, getting wealthy people to open up their pocketbooks. So through the course of this effort, I put together 1,000 people who donated up to $2.5 million, another list of almost 1,000 people who expressed in an unsolicited way interest in approaching our trials. So I knew that if this dam didn't break, I had this tremendous Rolodex of people who were a self-selected group of people who were definitely connected to type 1. And so we can literally profile these people because we can match them with our list. So what I did after the first 3 weeks came and went, we sent a mailing of 1,000 people. I wrote a letter to them, thanking them again for their donation, and then I wrote a little letter to my investors, letting them know that this is about being a stakeholder, not a stockholder. You may never see your equity, your money back. Nope, that's not the point of this. If you invest, $1,000 or $100 is inconsequential to us, what you choose. But I knew I had a way to play that next card and get 2,000 people who I could easily expect 10% of them to do something, and maybe quite significantly.
Marie, your question?
It was the same as Mike's.
Okay, so we had new person, Jonathan.
Yeah, so follow-up question. So if I'm understanding correctly, if you've received, let's say, $2 million in charitable donations, and by adding stock to it, even though the stock may or may not have any value, it's another ask that people will give again because you're giving them kind of a bit better offer to a charitable donation, and so it might not generalize to other companies in other situations.
Oh, I think we are. One of the reasons I wanted to participate is because I think we're really atypical. What we're doing is not a model,
Right.
Okay, but I'm here only.
You're like the perfect storm of all these things.
I think so. And by the way, the donations didn't come to BetaBionics. It didn't exist then. It went to Boston University, which is a 501c3.
Got that,
Right.
right.
But this, what we're telling people is now we've got to spin this out of the academic setting at some point because we can't commercialize. We can't scale and be you, right? So we're starting this entity, and we're a little fish competing against some big med tech companies who have stagnated the industry. So we're going to need your help. We're going to need your support, and in material ways beyond just investing. But this was the first way I could give them, besides their literal skin in the game, to give them some figurative skin in the game, an opportunity to feel like they own a piece of it the same way the Green Bay Packers are partly owned by their fans. The Lilly money went right to BetaBionics. That was our first capitalization.
All right, so actually, we're getting close to the end of the hour. So what I'm going to do is, these guys will be around. Let's more do final comments right down the road about final thoughts on this topic, and then you guys can grab them afterwards for some questions. Chris, why don't you start?
I'm happy to yield my time to someone who has a question instead. I mean, I think you guys know where I stand, which this is very, very interesting, but it's for a specialized type of financing and probably not for super high potential startups. Was there a question right there? Yep.
Yeah, I had a question for you. Given your particular business model, looking for stakeholders, I'm just curious, did you consider organizing as a cooperative rather than a equity corporation?
Yes, so I spent a number of years struggling with doing this as either a 501c3 or a public benefit corporation. I came to know about public benefit corporations in 2011, a little article on the back of an airplane, with C. Pongit. my wife brought it to my attention. I started pursuing this idea and learning more about it. Then Patagonia converted to a benefit corporation. Then Kickstarter did. So I started getting more and more interested in this. On the other hand, I started pursuing the idea of really wanting to be a 501c3. I wanted to do that more than anything else. Medical technology companies, 501c3. First, I had to find out if it was even possible to sell, you know.
But I didn't ask about 501c3s. I was thinking cooperatives, like Farmers Cooperatives, Ocean Spray, Ace Hardware. It's a completely different ownership structure.
Yeah, I did not consider that alternative.
Members basically have a share. It's not unlike a condo.
Yeah, we
Condo
did actually consider that, but we looked at like public charities versus private foundations, and I do recall as a subset of one of those was a cooperative kind of arrangement. So we considered that a little bit, like you have membership, right?
Yeah, that's
like a membership kind of arrangement. And we thought very long and hard about that, but ultimately we're
But
favoring.
if we had 3LC in Massachusetts, that would have been the perfect entity, you know, for you.
Right.
that you
Well,
could-
I thought about that too, by
Yes.
the way. I think the public benefit corporation makes a lot of sense because we ultimately needed to be able to capitalize, be able to ultimately reach out to this $1 trillion capital market that is there waiting for us if we ever want to do an IPO. And that was something that one of the mission statements was that how can we grow this company, reach as many people with type 1 diabetes as possible outside of the U.S. And that's when I realized that a nonprofit approach was really going to be limiting us. We don't need to be growing on revenue. To really grow in a dramatic way, we needed to be able to, reach the capitalized company through the public.
Mike, one last comment?
Super quick question. I don't know how I think they're called Chapter Bs, right, the benefit corporate? I don't know how you're structured, but how,
It's called
No, it's called a benefit corporation or a B Corp. It's not.
Yeah, I heard B Corp. Yeah.
Yeah.
So
Not to be
some
confused
Chapter S
with,
elections. I don't know if
BS.
they apply at all to you, but they definitely apply to C Corps that are new. You lose that as soon as you start selling equity. How does that work with
Because
it?
S-Corps are limited to 35 shareholders.
Yeah. So same thing. You lose your benefits, your tax stuff.
Well, S Corp is a particular status under the Internal Revenue Service,
Yeah.
which is how the
But
stock
you lose
get
the S
taxed.
Corp as soon as you do that.
A benefit corporation is a new type of corporation. It's typically a C corporation.
Federal government
Yeah.
No, but
C
you have
Corp.
you
Yeah.
have
And-
a sub-chapter
This is
S
this is
election that you can
Massachusetts
do.
statutory.
The main difference is that the directors don't get sued if they don't put the shareholders' interests first. Okay?
One observation about the benefit corporation, it's interesting because.
We should have a whole session about this.
I've also come at this from the benefit corporation point of view. There's a lot of back and forth in terms of are public benefit corporations worth anything? At the startup phase, a lot of the law professors out there are saying, well, they're not even worth anything. Nobody really needs it. No one ever got sued for doing X, Y, and Z. However, my view is that I think equity crowdfunding is going to become more and more integral to early stage companies, and that's precisely when you want to be able to say to some shareholder base, don't give me a hard time. We told you when you invested,
Right.
we're about type 1 diabetes, not making you money. So I think you are on the cutting edge, I think, of what we're going to see a lot more of companies like you for different reasons. Admittedly, you're a little bit of a one-off, but I think we're going to see a lot more competition.
I want to say one thing about this crowdfunding, especially in Ed's case. This is still the Wild West, okay? And so even though Ed, in his paperwork, is very clear about, I'm not giving you money back, right on the front page, Wefunder's page for you says, if you think you're investing in BetaBionics, is right, at a $100 million pre-money valuation for common stock.
No voting rights.
Pfizer has invested for preferred stock at $5 million at that same Lilly, sorry, my bad. At that same valuation, but for preferred stock. By investing in this company, you believe that this company will be worth more than $100 million when you sell it.
Right.
Okay?
That's their language, not mine.
That's their language, not his. But that's what I mean by the Wild Wild West, is this is not entirely within the entrepreneur's control. The portals have a big say. You are limited in what you can say as an entrepreneur. You can put a tombstone out that says, I'm raising on Wefunder.
Go see the site.
Go see the site.
Can't say
You
anymore.
can't say anything more. So there's all sorts of these regulations, and I think this is Christopher's point, that make it really tricky. And if you're successful, you're going to be in the crosshairs. Okay, just remember that. If you're successful with a big raise and someone comes and sues you, you're going to be the poster child.
The test case.
The test case.
Excellent. All right, that's a good way to wrap up. I know these guys are going to be around for a while, so you guys individually.
Kevin, Devin, can we just say something quickly before everybody starts
Sure,
the
go
network?
ahead.
Yeah, we just wanted to say we brought all these people to talk about it. It's obviously very topical in partnership with the venture capital.